In this month's update, we're going to spend a bit more time than usual looking at the state of economy as well as the markets. We're also going to talk a little bit, introduce and talk about the structure and the returns of the SIA ML Global Tactical Pool. And finally, we'll look at some of the recent portfolio returns and updates. March has been an active month for world markets, and our portfolios have changed to reflect that. So first of all, we'll start with monetary policy. Last week, the Bank of Canada cut its benchmark interest rate by 25 basis points to 2.75%. It was their seventh consecutive interest rate reduction, and the key quote that came out of that was. From the governors and the board was monetary policy cannot offset the impacts of a trade war. And that's pretty important. The Bank of Canada can only do so much, but a lot of it's going to end up playing out through the currency. The spread between Canadian interest rates and US interest rates remains quite wide. At yesterday's Fed meeting, the Fed kept the Fed funds rate in the 4.25 to 4.50 range. They made no change to the dot plot. Their forecast of basically the majority forecast of two US rate cuts this year remains intact. The FOMC members did lowered their GDP forecast, increased their inflation forecast, or in other words, they're seeing stagflation out there. And they are slowing their quantitative tightening programs. So they're kind of going from neutral hawkish to a solid neutral and maybe dovish. We'll see. But at least they aren't quite as hawkish as they were. And yesterday the markets responded quite positively to that. When we look at world interest rates generally, we can see that interest rates have been coming down, and that's generally a good thing. The orange line is the Bank of Canada. We can see has been cutting interest rates quite aggressively since last summer. The gray line is the US, where they did a couple of rate cuts and then paused, and that's why we're seeing this gap between the US and Canada continue to widen. But what's something that's really important is this. This is an estimate of GDP, Q1 GDP from the Atlanta Fed, and it's called GDP Now. And they kind of look at the economic data and coming in and kind of give a guess as to where they think the GDP might come in. And something we can see through 2024 and January was pretty steady, but in the last few weeks it's gone off a cliff. And it's indicative that perhaps there could be some bumps for the U.S. economy out there. I mean, there's tariffs, there's talk of trade wars, there's dramatic decreases in government spending, and those could play out and have an impact in the economy over say, the next 6 to 9 months. And it's not uncommon when a new president is elected, and that's why we have what we call the presidential cycle. It's not uncommon for a new president to come in and do all the cutting, the most contentious moves immediately as soon as they get in power while they have a mandate to do it. And so this is not unusual, but it the feeling initially after the U.S. election was that things would be sunshine and rainbows and Trump would get his way and everything would be wonderful. But the reality is that there could be significant bumps between point A and point B, and the Atlanta Fed's starting to show that in their estimates and guesses, and we're starting to see that a little bit in the markets as well, given the recent volatility. And speaking of volatility, we can see from this chart how much the trade announcements have sparked significant moves upward and downward over the last couple of months. Tariff delays, if we look at the green bars, everyone's kind of softening, delaying tariffs, and all these red bars are cranking up tariffs, and we're going to get you right now, and that it's expanded from China and Canada and Mexico to Europe to specific things for steel and aluminum and other things. So it's an ongoing issue that may continue to drive volatility in the markets. Looking at the equity action call, which is a measure from SIA charts of global equity market risk, money flows, and price changes relative to non-equity asset classes, we're seeing that it still remains in the green zone. Equities remain favored, but it's not up at 100 anymore. The equities aren't crushing it anymore. They are starting to weaken a little bit. And so we haven't quite dropped into the neutral zone yet. It is something that we're monitoring every single day. And but so far equities do remain favored, but they're, as I said, they're not quite as strong as they were. And we can see this when we look at our global map of country ETFs over the last month. We can see that there's been weakness, particularly in the United States, and it's very, very rare that we see the US dead last. And Australia is second last, and Canada is near the bottom. And Saudi Arabia has struggled too. On the other hand, in green, markets that have done well, Poland, Turkey, China have done, Spain, much of Europe have been doing particularly well lately. So we are kind of seeing this rotation from North American leadership to Europe and China leadership, and so that's something that's interesting. We haven't seen in a while. Something we're continuing to monitor as well as we move forward. Our look at sector scopes, which we is a study of the bullish percent of 31 industry groups, more or less level two sectors, and what we look at here is what percentage of stocks within each of these groups is on bullish signals. And so right now we're seeing they're mostly populated on the left hand side, but they're spread fairly evenly across the left hand side, which is lower. It's 0 to 50, and so that is indicative of a declining market. However, it's not, we haven't seen them really pile up in the leftmost sectors yet. So not an oversold market, a declining but not oversold market at this point in time. And the weakest sectors we're seeing have been in financials, things like banks and cyclicals, things like retailers and manufacturers and transports and things like that. On the right-hand side, the sectors that have been doing well, metals have done well because of gold stocks, with gold rallying above 3,000, and traditional defensive sectors, utilities, drugs, food, wholesale, telecom, like old school telecom. And those are the ones that have been doing particularly well and relatively outperforming and attracting more capital. In terms of seasonality, we've seen to start, if we go back and look at the red bars are last year, the green bars are this year, and the blue bars are the long-term average. So if we go to November, way out at the right after the election, explosive rally in the markets, second explosive rally in January. We had a small correction in December. Now we've had a bigger correction in February and March. Those early post-election gains are kind of unwinding here. Now we move into April. If we look last year, we had a big sell-off in April. This year, we see it in March. Has it been pulled forward a month? Maybe it's hard to tell. But then once we get past April, which historically has been a good month for stocks, we get into the summer, which is historically chopper. There's May, June, July, August, September, October. Those months are historically weaker and more volatile for markets. So something to remember as we move into the middle of the year. In terms of relative asset class performance, we can see the orange line is US, the S&P 500 ETF, and that was crushing everything for the longest time, and now it's really come off. And Canadian is the black line. It was doing okay. It kind of leveled off around October, around the time of the election when the tariff threats started to go, and we've seen it come down, but come down a little less than the US markets. The purple line is overseas markets, and we can see that is actually doing extremely well. And we've seen a little bit of improvement in bonds, not as much as international stocks, but it has, bonds have been bouncing back a little bit as well. And I like to look at gold versus Bitcoin as an example of investor sentiment. People go into Bitcoin when they're feeling confident, they're willing to take on risk, their risk appetite is high, they want returns, and they're going to go get it at the margins. And that's Bitcoin. And then gold, on the other hand, is the historic store of value where people put money when they're fearful and feeling cautious. So what we can see is, generally speaking, gold has been steadily grinding higher for the last year and continues to do so. And it has broken out over $3,000 an ounce and kept on going. Bitcoin had this explosive rally around the U.S. election, around the time, around the notion that the Republicans would be friendlier to crypto than the Democrats were. The Democrats hated crypto, and Trump had talked about building up a Bitcoin reserve and things like that. And then, then after this rally, it kind of leveled off, and now we've seen it come down, and we're seeing gold going to new all-time highs. Bitcoin coming down is indicative that investors are becoming more cautious, and that's what this relative performance chart tells us right now. So moving now, we're going to talk about the performance of the SIA ML Global Tactical Pool. And we'll start by explaining a little bit what it's about. It's a portfolio that's structured using relative analysis, rules-based trading, and it's made up of 4 sleeves. There's a 5-stock US mega cap sleeve. There's a 5-stock US sector sleeve, which is the strongest relative strength stocks from the 31 sectors that I noted earlier in the sector scopes chart. And then we have a 3-stock Canadian sleeve and a 3-stock international ADR sleeve. The 5-stock sleeves are about 31% each, and the 3-stock sleeves are approximately 19% each as target. However, we can see this has actually changed a little bit in terms of over time, based on performance. We've seen some sizable changes in the actual weighting. The mega cap sleeve is pretty close to target at about 31.4%. The U.S. sector sleeve has come down a little bit to about 27.75%. The international sleeve has done extremely well. And going back to my previous comments about the strength of international equities, the international ADR sleeve has done extremely well, and it's now about 23.25% of the portfolio. Canada has struggled, and I noted that a couple of slides ago, that Canada was struggling relative to the US and even international, and its weight has come down to about 15%. Looking at the trailing performance, this new strategy, this sleeves-based strategy, we implemented that on June the 11th, 2024. Our more recent performance in 1 month, this is up to February 28th, on 1 month was down 1.7%. 3 months was up 0.73%. 6 months up 21.2%. Year to date up 3.4%. And so we've seen that. We have seen significant change in rotation in the markets over the last few weeks. Looking at cash versus equity at February 28th, we were 97.5% equity. Geographic allocation was about 60% US, about 15% Canadian, about 23% international. In terms of sector allocation at the end of February, we were 27% financials, then followed by about 14% to 15% of consumer discretionary and industrials, information technology at 12, communications about 13, and consumer staples about 11. And in terms of contributors and detractors for January and February, well, noting aerospace sector has been very strong. Embraer and Howmet were among the largest contributors, plus Netflix. Among our detractors, we're seeing in technology in Celestica, Enerflex in energy, and Aritzia in consumer discretionary. It's a retailer, and of course those 3 are all Canadian stocks. So we're seeing strength in the U.S. and international, weakness in Canada, and it's a continuing theme that we've seen over this year so far. Finally, just want to note, we have seen a lot more volatility and a lot more sector rotation in the portfolio in the first half of March of this year. So we did want to at least give an update on what we've been up to and what's been going on in the markets. We've seen some significant sell-offs in the markets, some significant rebounds, a lot of back and forth right now, big battles going on between the bulls and the bears at the moment in the markets. And so in response to this increased volatility and uncertainty, this has sparked a lot of trading signals. We've seen a lot of rotation between sectors, and that has sparked significant signals and changes to the portfolio. So the first thing is, I said cash at the end of February was about 2.5%. That has now, cash and short-term fixed income has now increased into the 20 to 25% range. So we're about 75 to 80% equity, 20 to 25% cash and short-term fixed income. Also, I talked about previously about the cyclical sectors had been strong in February. Well, that has changed a lot. We have significantly rotated out of cyclical sectors such as industrials, consumer discretionary, and financials. And within the communications sector, our exposure has shifted from media companies and social media companies to telecom companies. So from the aggressive to the defensive. We're also seeing that, generally speaking, our exposure to defensive sectors, or places where people go when they're looking for more mature, steady, lower beta kind of companies, more, let's call it more value kind of areas. So consumer staples and healthcare, we've been rotated. The portfolio has rotated into that based on the relative capital flows and our rules-based trading signals. So looking ahead to the first quarter, we saw it in the Atlanta GDP. We've now seen it in the FOMC member forecasts. We're starting to see some signs in the North American economy of cracks forming. Last week we had multiple profit warnings from airlines. They're among the most sensitive to the economy, and they tend to see improvement and weakness first. So a big red flag running up there. We earlier this week we had weak retail sales, weak Empire manufacturing, weak Canada housing starts, and not like small misses. We're talking sizable misses in all of this data. The political event risks on the economy have increased around tariffs and trade wars. And one thing a couple of companies quietly started to mention near the end of the last earnings season was they started complaining about the impact of the higher US dollar on their earnings. The US dollar has done extremely well since the election. People think the US is going to win, and the dollar has been attracting capital. Now, at the same time, that's kind of started to change a little bit with international equities starting to do a little better. But for a while, the US was steamrolling everything. And companies are starting to notice. And a high US dollar is a big problem for US multinationals and US exporters. So even if they benefited from the trade side, tariff side, they could get impacted from the high dollar side. That's a big theme we want to watch for going into the next round of quarterly earnings, as well as just generally speaking, are people struggling with the overall economy? As I mentioned with the equity action call, SIA wealth indicators have started to weaken recently. I call it they've bent but not broken, but they have been bending. And we do continue to monitor trends in capital flows, trends in relative strength, our rules-based trading systems, and we remain prepared to make additional tactical net changes as necessary in the ML pool. So this is our disclaimer. At this point in time, I would very much like to thank all of you for joining us today, and we look forward to speaking with you again soon.